Hello and welcome to another episode of Angel Insights, the show that goes deep into the world of early stage investing. I'm your host, Tom Britton, co-founder of SyndicateRoom. And on today's episode, we're looking into a sector of FinTech that, quite frankly, has been neglected for a very long time. While the FinTech revolution in the last 10 years has made it incredibly easy to access credit with a single swipe, the technology behind repaying a debt has remained stuck in the past. Our guest today is Hannah Baynham. Hannah started her journey at the forefront of banking revolution at Starling before she moved into management consulting to advise global institutions on innovation. On our episode, we discuss why bad debt is often failure of design rather than affordability, the broken business model of lenders and how they write off debt, and why a million-person mission is both a social good and a massive market opportunity. Hannah, it's a pleasure to have you on the show. Thank you so much for joining us today.
Thanks so much for having me. Excited to be here.
I wanted to dig in a little bit to your history and understand your path into FinTech. Most people don't wake up one day thinking, I want to revolutionize debt collection. Walk me through a bit about what you did before founding this business and where the idea came about.
I found myself in the FinTech space while I was still actually at uni. I was studying here in London. I was lucky enough to be exposed to the sort of FinTech revolution that was happening 10 years ago with the likes of Monzo and Starling and all of these really cool consumer FinTechs really changing the game. And I was then lucky enough to get a job at Starling and really be a part of that amazing journey quite early on. And I think what really struck me at the time, which I suppose lit the pilot flame for me, was how these startups were using all of the amazing things that digital was enabling to actually make banking and financial services, things that are really boring. They're actually making them quite cool, things that people were excited to engage with. People were excited to download Monzo and have their golden ticket and all of these things. And I just thought that was fascinating and actually just really good that digital was being used as a tool to drive financial inclusion. And that's something I've remained really passionate about, obviously, after Starling going into management consulting, where then it was really working with much bigger financial institutions and banks on their innovation strategies. I'd never really worked on the debt side or the collection side of consumer credit. But what struck me after the massive socioeconomic events in sort of 2020 onwards in the following years was how many people I was interacting with, my friends, family, colleagues, who were struggling with unsecured consumer debt, whether that was credit cards or overdrafts or buy now, pay later, or a combination of those things. And that was shocking to me because these were people who have jobs that don't fit the stereotype of people in debt. What really struck me was that given all of the innovation that we've seen in banking, in savings, in wealth and investment, why are we not able to apply the same sort of technologies to this consumer credit and debt problem? And that's where it all began.
You mentioned before a little bit of the data and the scale of the problem. From my understanding, there's about £237 billion of unsecured debt in the UK, which I think averages out to around £4,400 per adult. That's an incredible figure. And as you mentioned, there are quite different products that people can take out. They've got credit cards, they've got buy now, pay later with the likes of Klarna and otherwise. I know it's a tough question, but is it too easy for people to take out debt in the UK?
I feel very strongly that it is way too easy. And I don't think credit is necessarily a bad thing. And people need it sometimes for the right things. But I think we do need to put up some more barriers and checks that make people think for more than 5 seconds about whether they really need a loan or an overdraft or a credit card or whatever they're buying online using buy now, pay later. It is just so easy. And I do think that's a massive problem.
It seems to me that this goes in cycles. If you go back 10, 15 years, you had Wonga, which was payday loans at very high interest rates, and then Migo loans and others. And now you have buy now, pay later, but what's the reality of them?
Well, I think when used correctly, they're great tools. I know lots of people who like to use buy now, pay later to spread the costs of big purchases, for example. And if you are able to manage that, then, why not? It is a great product. It creates a frictionless shopping experience. But the sad reality is that the majority of people probably aren't, let's say, financially organized enough to manage those repayments. And because it's so easy for that to spiral, because it's so embedded into just everyday shopping experiences, whether online, even in store now. So they're really tapping into this whole sort of social trend of instant gratification. And the big problem is where those checkout mechanisms have been applied to like very non-essential items, takeaways and things like that. And people really don't consider the consequences. And those consequences, when you don't pay later, you're in debt.
You and I had a bit of a conversation beforehand. You mentioned that about 60% of people receipt debt are employed and 69% of them have positive budgets. There's people that you wouldn't necessarily assume were in debt, hardworking individuals earning decent money, but they're using these products and possibly not understanding exactly how much debt they're getting into because of them.
All of this effort has gone into making the access to credit and buy now, pay later experiences are so easy, digital and on your phone, but then actually the repayment experience is totally neglected. It's still the same as it was 10 years ago or more. And so the problem is that it's not entirely an affordability issue. Of course, everyone's feeling the pinch. We're living through a cost of living crisis, but it's actually the fact that a lot of customers either don't have the financial education, don't have the organizational ability even to manage those repayments, but also aren't given the tools to manage them effectively, whether it's how often they make repayments or the flexibility they're given on their repayment plans to match their own personal situations. I think that's the big gap in this space.
So we started with the cart before the horse. You can get into debt, but we haven't yet developed the products or tools to help people manage that properly. Until now. You saw this problem. You saw the scale of this problem. Talk me through the thinking behind the business and when you decided to actually go for it.
Yeah, I've spoken a lot about the thinking, I suppose, more in terms of what we were looking at in the market and understanding how this market was working and where the gaps were. One of the things that Rob, my co-founder, and I did a quick and dirty sort of survey, and we put it online and we put on our winter coats and marched around the high streets and tried to ask as many people as we could what their sort of perspectives were on their credit repayments, whatever they may be. And what we found from those survey results was huge percentages, 80 to 85% plus, were people saying, yeah, I am worried about my ability to repay on my loans. And actually, I don't think that I'm getting the support that I need from my lender or the tools that I need to actually pay it off effectively. And I think the big thing was the percentage of people who were telling us that was having a big impact on their mental health. And I suppose that was speaking to people on the high street really gave us the energy that we needed to say, this is definitely a problem that's definitely quite overlooked. And what I've always felt is that it's such an obvious opportunity for everyone if we can try and fix this.
Excellent. For those that aren't aware, then, tell me about the business.
So what we set out to build at HaBO Money, I suppose the big gap that I keep talking about is the gap in the repayment experience. After borrowers have had really amazing digital, instantaneous experiences to get access to credit, the process of actually paying back on loans or credit cards or buy now, pay later is probably very impersonal. It will be some sort of probably legacy payment option like a direct debit. And really the experience just doesn't exist. And you'll probably only really be engaged with if you're in trouble, if you're falling behind for whatever reason. And we just thought there has to be a more proactive way. And so what we have built is a flexible and personalized repayment experience for people paying off consumer credit products. It's all about personalizing what people are repaying to match their individual circumstances, because everyone is unique these days, especially the sort of the work environment that we live in, where people are paid on different frequencies. Many more people are being paid weekly or fortnightly now. Not everyone is on a standard monthly income where you get paid the same amount on the same day of every month. So our platform's all about is understanding that person's income patterns and using that to create a payment plan that will give them the best chance of paying back their loans.
From the user experience perspective, it's super important these days to have something that you can easily set up and understand. How does it work for the user? Take me through I've come to the site.
Yep.
What am I doing next?
A user will come to us. They'll have been referred. Our business model is B2B2C. We work with lenders, with debt collection agencies, debt management plan providers, and the likes. And we actually allow them to extend our product to their customers, either at the point of distribution or as an intervention if a customer's fallen behind, perhaps, and looks like they might need an alternative solution. So the customer will come into the haboo environment. That might be white labeled if the lender would prefer that. And the first thing they will do is really establish their repayment preferences. It's about understanding, is the best time for them to repay? Is that weekly? Is that fortnightly? On the last Thursday? There are all of these insane options now for when people's salaries come in. There's also people who have multiple sources of income. And so it's about figuring out what is the right amount for this customer to pay and when. And so that is very much the beginning of that journey, is figuring that out as quickly as possible, using open banking data where the customer is comfortable to do so, to quickly figure those things out. And then once we've got all of that information, we're able to calculate a plan which is based on the monthly minimum established by their lender. So we don't interfere in their loan agreement or anything like that, but we just figure out the best way for them to meet their commitments. And then it's all about managing that plan over time, providing customers with the insights and always looking for opportunities to perhaps optimize the plan. Clear opportunities, again, in the gig worker space where salaries might fluctuate and you can pay more one month, less the next month, etc.
How does it work with someone who's got such variation in income? We've got a gig worker who might have a great month and then a poor month. So how is it adjusting to fit that style of income?
Yeah, so that customer still has to make the same amount of repayment to their lender every month. But what we help them do is when they have a particularly good month where perhaps they can afford to put a bit extra away, we can automatically take that bit extra, obviously with the customer's consent, and hold that in the haboo wallet, the save-as-you-repay wallet, so that perhaps next month or at some point in the future when they have worked less hours, perhaps they've been sick or they've been on holiday, they're able to then be cushioned by the pot that they've been building month on month in the good months. So it's all about building that financial resilience so that they're able to manage those sort of fluctuations themselves.
So this pot, so it's a savings pot, if you will, that helps balance the fluctuations. Where's that money actually held? Because that seems to imply that there's some banking facilities in this.
We are partnered with another FinTech called Britton Bank, are a fully regulated bank in the UK, and they provide the embedded bank accounts that are the haboo save-as-you-repay wallets in our platform.
Cool. So you're drawing on the FinTech network to build a product to meet needs together.
Exactly. Yeah. And that's something that you see these sorts of things elsewhere in FinTech. You see it all the time in wealth, for example, where you can have multiple pots and you can be putting away money as frequently as you want for your savings. And so really part of my obsession at the beginning was, why can't we just do the same thing to help people pay back their debts?
Definitely. There's a few other interesting features that I'm aware of. I know a lot of it's still in beta, but you have a save-as-you-repay function. Can you talk me through that a bit?
So the save-as-you-repay, it's another challenge in this market, and it's actually been something that's been spoken about quite a lot in the last 6 weeks or so. I think the FCA had a report come out recently which was showing the very low percentage of financially vulnerable people who had any sort of savings. And that's something that we're hearing all the time, that's actually really important, that of course customers want to pay back their debt. And perhaps the common sense might say, oh, any surplus income should be going towards paying back their debt. But actually then what that means is that customers have absolutely no financial safety net. So our idea is that while you are making your regular repayments to pay off your credit product, why don't you also be putting a bit away to actually save for that rainy day? And so that's what the Save-as-you-repay wallet is all about.
I definitely agree that's needed in trying to get people to build those good habits. But there's also been a wave of changes around consumer duty and in trying to ensure that customers achieve good outcomes, which is a vague term. But I do think that's driving change in the industry. And I'm wondering what you're seeing.
Consumer duty has been around now for probably nearly 2 years. What I've seen at least is, especially in the lending space, lenders and banks and credit unions all actually coming together to figure out what is the best way to be delivering good customer outcomes. Credit isn't necessarily a bad thing. Credit isn't the enemy, but the mechanisms that sit around it need to be around making sure that the right people get access to the right credit products at the right time, and that when it comes to paying it back, they are supported in doing so. And I think that there has definitely been a behavior change and attitude change from the lenders.
How much of the change or interest in these types of solutions is driven by that versus just the general desire to get the money repaid? From my understanding, there's something like 50 billion of UK debt that is effectively written off, i.e. no expectation on any of that being paid back. So clearly you've got a great product from the perspective of trying to help the customers repaying it, but the people who are ultimately benefiting from that repayment or the banks not having to write that money off.
Yeah, I think it's really interesting. And that what's been really fascinating for me is coming into this space with, I suppose, a very sort of common sense thought process about some of these things, which is surely if you're right, surely you don't want to write off that much debt. That's insane. But the reality is that the consumer credit sector has been built, and every loan book is signed off with bad debt provisions, and they know they're still going to make money. In fact, sloppy repayers and customers falling behind means they make more and more interest. So it's actually baked into those consumer credit risk models. That's how it's always been. But I think what is changing is partly driven by consumer duty. And okay, fine, economically, you're fine with writing off that much debt. But is that actually, what does that actually mean for the individuals whose debt you're writing off? You're marking their credit scores. You're impacting their ability to borrow in the future. You're really damaging their overall financial well-being. And I think that's a big attitude change in the sector.
Given that you're benefiting both the individual in debt and the bank, how does the business model work? How are you generating your revenue?
Yeah, so it was something that we realized quite quickly that we could never charge consumers for our product and service. Our business model is to charge lenders or our clients, whether they're lenders or debt collection agencies, a very small percentage commission of all successful repayments made through our platform. And that would be competitive with what they're already paying for payments elsewhere.
I'm a little bit surprised you mentioned the debt collection agency. So you're not just serving from the originator of the loan, you're also serving on the ones that they've hired to collect the debt. So you're tapping into both?
The product definitely works in both spaces, the debt collection agencies and debt purchasers as well. They all have collections is what they do. And so we're definitely we think that probably our sweet spot is more on the lenders directly, but there's definitely applicability in any organization that has a collections challenge.
Clearly there, if you're doing it well enough, then you'll be putting many of the agencies out of business. Just surprised me a little bit.
I think, unfortunately, there will always be a need for debt collection agencies. Obviously, we are very optimistic and we believe that there are lots of misconceptions in this market around people's appetite to pay off their debt and take the right steps to do that. But I think ultimately there will always be people who are perhaps struggling more than others, people who are less well-intentioned than others around repaying their debts. And so I think the debt collection agencies, there will always be a need for, I suppose, the more hands-on agencies. But I think what we're hearing is that how can those debt collection agencies, for example, be more efficient? And if they can service more of their customers with off-the-shelf self-service platforms, then that increases their capacity to provide a much more hands-on experience with the customers who really need that more hand-holdy, much more proactive, much more person-based approach. And it'll cost them less to do it because they'll need less people.
It sounds like you've got this great product, and there's probably quite a few different segments of individual who can use it. As you're rolling it out, are you targeting one segment in particular over others, or are you just trying to cover the whole field?
We're definitely trying to be as focused as possible in our go-to-market. Where we've found the most traction and positive feedback so far has been in the near prime lending space, and that looks like non-bank personal loan providers who probably only do personal loans. Maybe they might offer credit cards as well, but they're very specialist in that. And that's become a real sweet spot for us. That being said, of course, being at the stage that we're at, we dip our toe into other waters. We've mentioned debt collection agencies. That's something that we are exploring. It wasn't somewhere that at the beginning we thought we would want to go after, but we actually are seeing an opportunity there, as well as other loan types as well that could become interesting in the future.
Speaking of the future, you're focused on consumer debt at present, but are there other areas of repayments that you could tackle?
I think what we're focused even more specifically within consumer debt is actually the personal loans market, more broadly than just personal loans. You've obviously got credit cards, which is an enormous market. But then even within consumer debt, there's also other debt types. Perhaps auto finance is a really interesting space that we're keen to look at more. And then other perhaps bigger types of debt that we think consumers could definitely benefit from a proposition like maybe mortgages, which is obviously enormous. We haven't really spent that much time, but we are excited about potentially looking at that. And the other area that I'm really excited about is potentially student loans. I think that people like me have a hell of a lot of student debt that we think, I'll probably never pay that off because it's such a big number and the interest is blah. But actually, with the right sort of tools and the right incentives, you could be taking chunks out of that with the right experiences. And I think that's another really untapped space in this market.
You talked a lot about the product itself, but clearly you're getting a lot of data on the individuals and their habits. Is there any play in that space where you could then feed that back into the providers and the originators?
Yeah, it's a huge space, and it's something that the prospective clients that we're speaking to are so interested in as well. A big part of consumer duty is around the identification of customers showing signs of vulnerability, for example. And with the data that we're able to collect, not even without even touching open banking data, purely engagement data, how much are customers engaging with the haboo experience, how much are they taking advantage of the payment flexibility that it offers. Those are really valuable data points that we're able to share with lenders and spot worrying patterns or flags that perhaps a customer needs a bit of help. Looking at things like income patterns, for example, you could quite easily spot if a customer has maybe lost their job, or if a gig worker has not been able to pick up shifts for the last 2 weeks. And those are things that typically lenders wouldn't know about until after a missed payment event. Whereas if we can bring that forward, we can get customers the help they need before they really need it, using the insights that we're able to collect on the platform.
I'd be remiss to ask, are you using AI in any of this?
Yeah, I think it's definitely something that we're exploring at the moment. We've built something as reliable as possible and as quickly as possible that we felt comfortable building. But eventually, I think there is such an opportunity. We've spoken a lot about the data. I think for us, it will be around automation of those payment plans, especially for people with fluctuating income patterns. I think that will be an immediate use case for AI. And then I think also a really interesting space that we aren't really in, but we'd probably love to look at partnering at some stage, is in the sort of AI-driven advice. How can we help customers navigate their debt journeys? We take very seriously the sensitivity of the customers that we would be dealing with. And so we're very careful and cautious about any sort of implementation of agents or robo advice, especially when it comes to advice, working with the regulator and other players in our ecosystem, navigate that as effectively and cautiously as we can.
It sounds like you're on the right track, and we at SyndicateRoom are delighted to have you as part of our Access Fund portfolio. I like to wrap up episodes with a few rapid fire questions. So don't think too much about it. First thing that comes to mind. You ready?
Yes, let's do it.
Sure. Number one, what's the biggest misconception people have about debt collection?
I think it's that debt collectors are all evil people who come banging on doors and ruin people's lives. The majority of people in the debt collection space actually have the customer's best interest at heart. They actually treat their customers in a very humane way. Unfortunately, the industry's been tarnished by the very negative outliers who are more aggressive in their collection tactics.
It's always the outliers. Question two. What one regulatory change would make the biggest impact on the UK's debt problem?
I don't know if it's the biggest impact, but the change I'm most excited about is the regulation around buy now, pay later, around bringing affordability checks into buy now, pay later journeys to make sure that people are only really accessing those types of credit products when they can really afford and have the means to pay back.
I agree. Question number three. What's the best book you've read recently? Can be business or pleasure.
I wish I could think of a really amazing business book, but most of my reading time is on fiction, one of my extracurricular passions. I think the best book I've read recently is Piranesi by Susanna Clarke.
Well, give us a quick synopsis.
Oh, it's so weird. It is about a very mystical house. There is a being in there called Piranesi who is figuring out where he is, what this world is that he lives in. And that's probably all I can say without giving too much away.
We'll add it to the source material for the next question. What's one piece of advice that you find yourself always going back to?
One of the best pieces of advice that we have had from one of our advisors on this journey is to be more demanding. I think being first-time founders is really easy to suffer the usual imposter syndrome, but actually we know that we have a right to be demanding, and that the only way we're going to make things happen is if we go in and tell people what we want and get people to do stuff with us.
Fantastic. Let's fast forward 5 years. You're obviously achieved a number of things. What does success look like for you in the business?
It's actually really timely because we spent some time last week writing down a mission and vision. Sort of what we came up with as our 5-year mission is to help at least 1 million people get out of debt and crucially get them into savings. So not just out of debt only for them to fall back into debt, but actually help those people with the longer term, really good financial habits that will not only get them out of debt, but actually get them into a position where they can save and do nice things and have the financial resilience that they need to get through life.
I like that mission. So for anyone who wants to find out more about what you're doing, where should they go? What should they do?
They can check out our website, www.haboomoney.com, or they can follow and connect with me on LinkedIn. I'm Hannah Baynham.
Hannah, it has been absolutely a pleasure. Thank you very much for sharing your journey. I hope that we can revisit this in maybe a year's time, because the product will have launched, we'll have had traction and feedback. So I'm going to put it in my calendar. And then so for one last time, thank you so much for joining us, and we'll speak soon.
Thank you very much, Tom. It's been a pleasure.
Well, that's it for this episode of Angel Insights, and I do hope you enjoyed hearing from Han as much as I did. For me, the standout insight was the shift in the lending mindset, moving away from baked-in bad debt provisions towards a more proactive data-led engagement model, actually build a customer's financial resilience rather than just making their credit score. If you enjoyed this episode and want to learn more about Hannah's mission to move 1 million people from debt into savings, you can find them at HaBO Money or connect with Hannah on LinkedIn. And as always, if you want to find out more about SyndicateRoom, head on over to www.syndicateroom.com or follow me, Tom Britton, on LinkedIn. Please do consider liking and subscribing and join us for the next episode. Until then, have a great day.